Hello, everyone. Welcome to this Technically Art seminar, Financial Literacy for Artists. Thanks to all the Juno folks here in person who came despite the weather. We appreciate you, and thanks to everyone online. Um, my name is Spencer Edgars. I'm the Marketing and Communications Coordinator for the Juno Arts and Humanities Council. I dropped a message in the chat. If you want to hear more about sessions like this, make sure to sign up for our newsletter and follow us on socials. But yeah, thanks for being here. We're so excited to have Ryan Beason from Elgee Rehfeld here to present today. Ryan is a tax partner at Elgee Rehfeld. He brings over 13 years of in-depth, easy-to-work-with experience to clients in both the public and non-public sectors. His focus is on tax work and consulting, with specializations in individual returns, partnerships, CNS corporations, tax planning, tax consulting, and elections. Yeah, so we're gonna probably, if you have questions, Ryan's okay with, we can bop in questions in and out. Zoom folks, I'm gonna ask for now, if you just type questions if you have them. We'll have time towards the end where we can have people unmute and ask questions verbally. But yeah, thanks, Ryan.
Yeah.
Take it away.
Thanks for having me. And today is just going to be kind of a wide array of topics, discussions. I figured anything I felt was pertinent to the arts industry or just anybody with their own business. And then I'll just talk about just general taxes towards the end of things, new for 2026, things that I think might be applicable. But yes, feel free to ask questions or put your hands up any time or in the chat as well. Like Spencer said, I'm a partner at Elgee Rehfeld, been a partner for 5 or 6 years now. A little bit about me, born and raised in Juneau. Graduated college in 2011 and started working for Elgee Rehfeld. Other than that, I grew up in the commercial fishing industry, so I did that all the way up till a couple of years ago. I fished, took time off in the summer, and then obviously did accounting the rest of the year. And obviously now I'm just a full-time accountant. My dad recently retired, so no more commercial fishing there. Um, so I figured I'd just talk about bookkeeping basics. As you can kind of see here, there's a few different things. And I will say whether, you're just starting a new business, been in business for 10, 20 years, or whatever it might be, I just hope that you get something out of this today that is somewhat useful. And obviously questions help. If you have questions, just let me know. But the first thing is kind of just starting out here is the one thing I always recommend is kind of setting up a business bank account. Intermingling funds just gets really messy. Whether with the new business, it's, come around tax time the next spring, you're going through your bank statements, whatever it might be, credit card log. It's hard to remember what everything's for. So that's the first recommendation is to break things out, have a separate bank account, separate debit card, separate credit card, whatever it might be. Just makes things a whole bunch easier. Because otherwise there may be things you're missing out on if you can't remember what an expense might be. Budgets are great. And things do always change, but if you're trying to see if your business can be profitable, it would never hurt to create a budget, whether, I don't know, high level, very detailed, whatever works for you guys. But it gives you an idea that at the end of the year, you can kind of compare and contrast and see what happened versus what I thought was going to happen. Kind of with that next one is just organization as well. I can't tell you how many people come in with very unorganized receipts, shoe boxes. It's just more organized, the better. Later on, I'll talk about some options that I might recommend for organization. But whatever way you do choose, try to be somewhat organized. Deadlines are huge too. Just as you know, for individuals, April 15th is the due date for taxes. Extension due date is October 15th. If you happen to have like a corporation or a partnership, those are due March 15th. And then extension deadline is September 15th. So just keep those in mind because the IRS does charge penalties. So, and it can be significant potentially if you do a lot of the money. So just keep track of those. And it's good to at least be aware when stuff is due. Next is taxes. Hopefully you're profitable. Hopefully you're making money. But the IRS always has its hand out. So I'll talk about just kind of different types of taxes, especially for people who might have their own business in the arts or whatever it might be. But just be prepared. Taxes can be a big shock, especially if people are new to having their own business. It's a little different than being a W-2 employee. So here, kind of record keeping. As you can kind of see here, I have a few different options here. As a shoebox method, I would never recommend. I will say, being in the commercial fishing industry, having some commercial fishing clients, fishermen are at the worst. I mean, not to harp on them, but I don't recommend the shoebox. Any of these other ones here, handwritten summary works great. It's like me doing your taxes for the most part. If hypothetically, I wouldn't need every receipt. I would request some sort of summary. If I ever question something, I may ask for a receipt. It's your requirement to keep those receipts in case you ever got audited by the IRS. Side note, the IRS can go back 7 years. So 7 years of documentation that you should have. Excel works great. If you're familiar with computers, Excel is a very useful tool that I would highly recommend. And then depending on where your business is, the size of it, there are accounting softwares. The most common one is QuickBooks. Within QuickBooks, there's what's called QuickBooks Online, which is essentially just a web page you go to and log in. Anywhere you have internet access, you can do that. There's what's called QuickBooks Desktop, which is actually an application on your own computer that you can use. They're kind of going away from the desktop and pushing QuickBooks Online, but it is a good resource. I will say, be careful. QuickBooks can be very helpful. It can import your bank statements, import your credit card statements. But if you're not familiar, you can double import things and just create a mess like you wouldn't believe. So yeah, that's where I'm saying is Excel works great. Again, if you're going to do QuickBooks, maybe do some research. Lots of good YouTube videos out there. Even if you're at the size of a bookkeeper, may make sense, but just be careful. QuickBooks does payroll too, but so does Gusto is another program we use. That if you do have employees, it's useful to use something like that, and it's probably cheaper than paying a local bookkeeper. So if you just start a new business, don't have a lot of extra cash, Gusto might be a good way to go. Side note here, if you are your business owner and you're not a corporation, you will not pay yourself W-2 wages. Just keep that in mind. I've seen incorrect people do that. They have a sole proprietorship, LLC, partnership. You do not pay yourself W-2 wages. So keep that in mind. If you go to the corporation route, yes, we'll talk about that more. But just the side note there is you should not be paying yourself W-2 wages.
What does that mean?
Obviously you know what a W-2 is. So when you have your own business, it really doesn't mean you don't pay yourself W-2 wage. You can per se write yourself they call it a draw or distribution once a month, twice a month, whatever it might be. But that's just essentially writing a check to yourself, which really means nothing from an accounting perspective or tax perspective, because those draws, and trying to confuse people here, but the draws are not an expense. You're taxed on the income from the business minus the expenses, whatever's left over, that's your taxable income. What you're pulling out of money on the side over here for draws to live off of and whatever else might be, that's completely separate. I will say that it's a very confusing terminology and how to work around it. I will say that's probably one of the most common questions I get is, I'm not paying myself W-2 wages, so how does it work? Yeah, essentially it's just writing yourself a check or transfer from your business bank account to your personal bank account. And like I said at the bottom there, avoid intermingling if all possible. It just makes it messier, and you may be losing out on potential deductions if you don't know what the charge was for. Next here is kind of different elements of bookkeeping. I'll walk through these. Some of these are probably somewhat familiar, some may not be. But assets, pretty straightforward. Cash is probably the biggest, obviously, asset. But other ones are inventory, equipment, whatever they might be. But those are your assets. That's the value in the business. Liabilities, pretty straightforward. If you have any loans for the business, if you have any accounts payable for the business, essentially if you owe anybody money for whatever it might be, that's a liability to you. And what they say is assets minus liabilities kind of equals equity. So that's the value you have in the business. If you ever hear, you're kind of upside down or underwater, that would mean your liabilities are kind of in excess of your assets. So if the business were to shut down tomorrow, you wouldn't have enough assets to pay off your debt. It's kind of that. And yeah, you want equity to have a positive value. So just keep that in mind. I do see people who go out and have a bunch of loans for the business, and it's a lot of risk involved. If something were to go south and it were to close down, you obviously wouldn't be able to pay off your debts. Gross income, pretty straightforward. That's the gross amount you bring in before any expenses. So that's, a lot of you'll see or whatever you use, but that's the top line on your income statement is the gross income. Obviously, net income is after all your expenses. So supplies, repairs, office expense, depreciation. After you take all those out, that's your net income. Like I said, expenses here. It's just what money out the door. Yep. Question?
How do you calculate the depreciation assets?
So for tax purposes, I'll get into a little bit further later, but there's the IRS has its own method of depreciation and how useful lives. Most of it will be 5 to 7 years, and they call it MACRS, MACRS. It's modified accrual recovery system. I'll get to it in a second here, but on the tax return is where it's calculated.
Is net income the same as profit?
Pretty much, yeah.
Would you mind just repeating the question?
Oh, okay.
Since you're closer to the microphone for our Zoom folks.
Gotcha.
Appreciate it.
I guess the first one is on depreciation expense and how that's calculated, and that's done on the tax return. And if you're working with a tax preparer, that's kind of one of the options and planning options is where you can discuss how much depreciation you want to take. And the second question, I'll talk about depreciation a lot more later. The second one is profit and net income, the same. That essentially, yes, if you're making money or not, and obviously a net loss would obviously mean you're not making money. And cost of goods sold, that's kind of the direct cost or what's into the product you may sell. So you'll hear cost of goods sold sometimes. So that's if you're making a product, whatever costs are directly in that product, or if you're providing a service or your own time in that's kind of what you value your cost of goods sold. And then your other expenses are just your normal office expense, rent, whatever it might be. So financials. The biggest thing is just understanding the numbers here. The biggest thing is if I'm making money, am I not making money? If I'm losing money, where can I improve? The first one, income statement, also called profit and loss. Essentially, it's the same thing, but it's a summary. Typically, you do it on the calendar year end, especially for taxes, obviously, but you summarize all your income and expenses over that time period. And this is probably the one that, you should have the best understanding of, because hopefully your business is making money. And if it's not making money, you can maybe explain why. And what I do too, just, a lot of my clients use QuickBooks, but you can pull what are called comparative financials. So you compare year over year to see where things increased, where things dropped off, or wherever it might be. It's good to compare. A balance sheet might be less familiar to most of you, but essentially it's a sheet that balances. Kind of a step back to the previous slide. The balance sheet is assets, liabilities, and equity. So it breaks all of those out together. Depending on how you're structured for tax purposes, you may not need to worry about this for reporting. But if you are potentially a partnership or a corporation, you need to maintain a balance sheet. And it's good. It's just like I said, it might say that, okay, I have more liabilities than assets, that might be a problem, or it may not be a problem, but it breaks out the picture of how things are shaking out. Cash flow statement, this is probably the least used of the three. And this just shows where the cash is going in and out. And, question is, how is this different from an income statement? Because that's essentially doing the same thing. The cash flow also takes into consideration maybe a loan you bought a piece of equipment. So you're paying that off over the year, and a part of that payment's principal and a part of it's interest. The principal portion is not an expense. You've already purchased the asset and getting depreciation, but it's still cash out the door. So a lot of times what'll happen is if you're highly leveraged, a lot of debt, you may have all these big payments out the door, but you're not getting expense for those. So it can be difficult where on your income statement of profit and loss, I'm showing income, but I got no cash because I'm paying all loan payments. So that can be tricky for people at times. It's like, uh-oh, I have no money to pay the tax. So just keep that in mind. And there's other statements you can look at. I mean, as you get bigger, there's payroll summaries. There's kind of, I also look at like additions, all the new assets throughout the year and stuff like that. But I would start, especially income statement and balance sheet. Those are probably the two that have the best understanding of. And other business items. First one is value in goods and services. Especially with new businesses, I always talk to my clients, how do you value your time? And it's a struggle because in one respect, you're not wanting to overcharge your client and feel like you're trying to rip them off, but at the same time, you want to make a comfortable living. It's a difficult balance. And what I'll typically see is, especially with new kind of single owners, they're not charging enough. And what that does, it only hinders them in the long run. Because if their business is starting to grow, I want to hire employees. And, if you're not charging enough, how can you actually hire an employee, maybe provide them some sort of benefits? So just, obviously you guys are familiar with the industries you're in. And it's just one thing is don't undervalue yourself. Try to come up with a reasonable, if you're going to spend however many hours on this project, come up with a dollar amount you think you should be charging for yourself to actually make comfortable living, to cover your taxes, cover anything else you might have going on, because it's only going to hurt you in the long run. Business license and other filings, obviously, CBJ or wherever community might be, and there may be business licenses to file there. Other things, the state filings for an LLC or a partnership, whatever, you might have to file some paperwork with the state of Alaska. Sale tax, that's a big one. Make sure you at least touch base with wherever your locality is, touch base with the local office there to see if you are required for sales tax or not. Because, they will eventually catch up with you, and it won't be pretty if you purposely try to avoid not having to pay sales tax. Estimated taxes. This comes up a lot. If you've been in business, have your own business, self-employed for a while, you're probably somewhat familiar. But if you're not, it's something new. Essentially, these are quarterly payments made throughout the year. Think of yourself as an employee. In the past, you get paid every 2 weeks, and on that W-2, you can kind of see the taxes taken out that you're paying and the taxes taken out that your employer is paying. And those are taxes are called Social Security and Medicare taxes. Being self-employed, you're not doing that. And the IRS says, well, we want to make sure you can essentially pay us, and we want you to pay throughout the year instead of all at one time at the end of the year. So they want quarterly estimated tax payments. And how these work is they're based off your prior year tax return. So if in the prior year, if you owe more than $1,000 in tax, estimated payments are automatically calculated for the following year based on that. Again, they're not required, but the IRS will charge you interest and penalties if you owe the next year on your taxes. So I have clients who religiously make these. I have clients who say, absolutely not. I'll give the IRS my money at the last possible minute, and I'll pay any penalties or fines associated with that. The more you owe, the larger the interest and penalty and fines on that. So it's two trains of thoughts. But at the end of the day, some people also with that say, I can make more money investing it or keeping my money than giving it to the IRS. So just keep that in mind, that, it's being self-employed, having self-employed income, estimated taxes will come up. The last thing here is kind of back to QuickBooks. So with bank statements and credit card statements, it's good to reconcile your bank account. And what that means is each month you get your statement, and you kind of go compare your statement to your QuickBooks account, whatever it might be, and verify, yep, this transaction cleared, no, it did not clear. And it kind of paints the whole picture. Otherwise, that's where I've seen the issues of, double payments booked in there for the same thing, double expenses, and it can get messy. So if you do use QuickBooks, make sure you at least reconcile. That's done monthly. Make sure that's done, because otherwise you don't know if you're missing out potential income, potential expenses, or whatever it might be. So kind of expensing versus depreciation. So kind of the first thing there with depreciation, I will say with having your own businesses, whatever it might be, in any field, arts field, anything else you might have, depreciation is probably the biggest planning opportunity. Just because you can, in the first year, if you purchase, I don't know, a very expensive piece of instrument or whatever it might be for the business, you can potentially use accelerated depreciation options. You can say, instead of depreciating this over its useful life, which might be 5 to 7 years per the IRS guidelines, I can take that entire expense this year and reduce my income by that amount. Or I say, no, I don't want to take accelerated depreciation. Let's spread it out over its useful life of 5 or 7 years. Different trains of thoughts there. A lot of people like the deduction now, saves them money, more money in their pocket, more money them to put back into the business and grow it potentially. You can see there's this de minimis safe harbor election. And what this is, it's an election we make on our tax returns to essentially tell the IRS, if I'm buying a piece of equipment and it's under $2,500, I don't need to depreciate it. I can expense it as a supply, small equipment. And what this does is it keeps your depreciation schedule, your fixed asset schedule on your return. It keeps it a little more condensed. Otherwise, if every couple $100 item, your schedule could just get through the roof, and it provides no benefit to anybody being that long. So that it's just kind of an easy way to say, nope, I'm going to expense it if it's under that amount. And that's per item too. So if you buy 4 of the same item for $8,000, that's $2,000 a piece, you can expense the entire $8,000. Like I said, depreciation, it's modified accelerated cost recovery system makers. It's just the IRS method for depreciation. And it's not what people might think of a straight line. It's not your cost divided by 7 years. They come up with this formula, and it's more heavily weighted in the first few years. So you get a larger depreciation expense in the first few, a little bit smaller in the last few years. And at the bottom there, those are the accelerated depreciation I was talking about. Bonus depreciation, you may have heard of before. Section 179 depreciation, you may have heard that. But with my clients who, whatever field they're in, have their own business, this is kind of the last item I do. I'll tell them, hey, I got the return done. Let's talk about depreciation. Do we want to take accelerated depreciation? If we do, you're going to save this much in tax. If we don't, you're going to pay approximately this much. And the one thing just to keep in mind is that you're losing that deduction in future years. So some clients will get in the process of thinking they have to buy something every year to get that deduction, which is not a good. I would not recommend that. But just keep it in mind, you have a lot of options there. And it's not, like I said, you don't have to make a decision until you actually file your taxes. So whether it's by April 15th or October 15th, if you're on extension, you can still make a decision for that previous year. Nothing has to happen before the end of the year there. Kind of some common business expenses. Talked about depreciation, supplies, inventory. This is an interesting one. Do we track for taxes or not? So there are provisions within the IRS, that say, you can elect not to track inventory for tax purposes. It's essentially, if you bought that, whatever it might be for inventory, clothing or whatever it might be, you can expense it in the year you buy it. Versus if you do keep track of inventory, you don't get to expense that item until you actually use it to maybe make that product or good or service. And the one thing with inventory it can be that I've seen is potentially a client buys a bunch of their product right at the end of the year. So they use a lot of their cash up, but for tax purposes or tracking inventory, they don't get to deduct those costs until they use them in the following year. So I've had issues where clients have spent money to pay their taxes. So it's one of those things just to be careful. I have clients that track inventory. I have clients who've elected not to track it. There are ways where if you do track it and that later on in the future decide to change methods, you can do an election to essentially say, no, we're going to expense inventory going forward. So it is an option. Again, I would, if you're doing that route, probably talk to a CPA or a tax preparer. Travel is a common one. Per diem, you've probably heard per diem before, but if you're traveling for work to a community, you can take your actual costs or you can take the per diem rates for meals and incidental expenses. Like for Alaska, they have a rate for almost every community, obviously down south, anywhere you go. But the trip obviously has to be for business purposes. You can't take a vacation and say I'm going to spend a day or two doing something like that, but it is an option. And per diem is almost always more beneficial. And then just with that too, as you may or may not know, meals, you can only deduct to 50% of the costs. So whatever the cost is, you're only get a deduction for 50% of that in your tax return. Yeah.
So if you're having a work trip, say, so for like the first half of the trip, say you're flying down south for a convention or something, you have the convention and then you spend the second half of the trip doing a personal vacation, how would you divide out, say, the costs of airfare for it?
So good question. Because I get that a lot where maybe not so much 50-50, but it's, I'm going to a week vacation and attend a seminar for the last day or two. It goes back to the intention of the trip, is how I say it. So if it would, your case is more 50-50, I would try to come up with some reasonable allocation with that. And it's one of those things where if the IRS ever looked at it, you'd have to justify why you took what you did. There's no right or wrong answer. Yeah, this amount you can deduct, this amount you can't. It just comes back to what's reasonable. And that's a lot of taxes. What's reasonable? What can you actually justify if you're ever looked at by the IRS? Home office, this is a big one. And if you have a dedicated home office, 100% business use, what the IRS says, you can take a deduction for that. Just as a FYI here, if you have a separate place, maybe you're renting for a business, have an office there, it gets tricky because you have an office. How the IRS saying you have two offices now, how can you deduct both of these? So just be careful with that. It may not work in that situation, but if you don't have an office separate from your house, you can have a home office expense. With that, there's the standard method versus the actual cost. Standard method is $5 per square foot. Whatever your home office is, 100 square feet times $500 deduction. Or you take your actual costs. So if your home office is roughly 10% of the house, take 10% of your mortgage interest, property taxes, home insurance, utilities, any other shared costs that you have, essentially you deduct that.
What if you built like a separate unit away from your house? Would it cover some of the costs for that?
So, bring that up is you can also take if you build a separate unit or something like that, and it's still a shared cost, you'd allocate those out. But if the cost for building that, you would take depreciation expense for that. So if I built not commonly, you build a separate outbuilding on your property for $25,000 just for your business, just for your home office, you could depreciate that on your tax return.
So how would that work? It would be a one-time.
So how it would work for that in that situation for depreciation in real estate, there's no accelerated depreciation options. So for that situation, the IRS says that real estate would be 39-year property. Essentially, take your cost to build that building divided by 39, and that's your deduction per year. So it's a very small deduction. There's not a lot of planning opportunities with real estate, but that's how that would work. And back to your home office, if it was just part of your house too, that you talked about 10% being a home office, you could take 10% of the purchase price of your house for that. Just realize for depreciation, but just realize your house, the value, a portion is to the house, the building, a portion is the land. So land you don't depreciate, it would just be the building portion. So it gets tricky, you bought it for $500,000. What's my land value? A lot of times what we do is just go to city and borough assessment, and they have a breakout between land and building, and that ratio is what we usually use for allocating it.
Any difference between garage use for the business versus house?
No, as long as it's 100% business use.
Okay.
That's what they say. So just be careful with that.
So would you say that the easiest option for that is to do like the $5 per square foot method if you have just a dedicated home office?
Not necessarily. I would do what everyone provides the larger deduction. So, and typically, at least the first year, I tell my clients, let's run it both ways to see. Some clients who are just unorganized, simplified, the standard method makes sense. But if you can go through, the biggest thing is keeping track of utilities, because that's the hardest part is tracking those. But typically, the actual cost is better, I have to guess.
If we need more information on that, can you send that to us? Because like for homeschooling, I will have an office and then they'll be taught in my home.
It gets tricky. There are special rules for that. And I don't know if it would necessarily apply to your case or not. It's more for like childcare and home stuff, but that's not what you have. I'm assuming no. It would get tricky. It'd be worth the discussion. Because there's no no set method or how do I treat this, but it'd be worth a further discussion. I'd be happy to have with you.
Okay.
Yes,
So, sorry, going back to the garage thing.
yes.
If there is a set space set aside in the garage, do you measure just that space or does the whole garage have to be used for just that?
No, you can measure just a space used for the business. So it's very common where only part of it's used. And kind of next thing is kind of similar, but auto. So if you have your vehicle and you do use it for your business, it's kind of the same thing. Take the standard mileage rate, which is essentially per mile you get. That's up in the 70 cent per mile. So you just keep track of your mileage and do the standard versus actual. It's where if you have a loan on it, your car interest, your repairs, maintenance, fuel costs, all of that. You can do that. And in this one, I say most people probably take the standard mileage rate because it's just a lot easier. But the one thing is the IRS, I know many people don't do it, but the IRS says you have to have a mileage log. So I know like a lot of realtors will there's apps you can download that kind of track that for you. But if you were to ever get audited by the IRS, they would ask for your mileage log. So just keep that in mind. And just have whatever you do, it needs to be reasonable. We understand your vehicles are used personally and for the business, whatever it might be, has to be reasonable. And I will say with that too, if you do have like a dedicated office space that you rent and go to each day, whatever it might be, you driving from your house to that place is not a deductible business expense. That's more of a commuting expense. It's like any W-2 employee. They got to drive to their place where they don't get a deduction for that. But if you're going from your place of business to deliver mail to the post office, deliver stuff around town, get something for the business, that's where it becomes a deductible expense. So that can be confusing. Next one is health insurance. There's what's called the self-employed health insurance deduction. So if you're paying like through the online marketplace, paying health insurance premiums, that's a deduction in your tax return. It's not directly related to the business. It's not reported with the business income and expenses, but there is a deduction for that. So keep that in mind. If you're having out-of-pocket health insurance that you're paying, whatever it might be, you can get a deduction for that.
Like I'm on Marketplace and it's me and my child. Mm-hmm. Will they only deduct for me or do they deduct for the whole
thing?
It's the total.
Yeah. Great. And just as a side note, with having health insurance in the marketplace, just be careful when you estimate your income for the next year, because what can happen is you way underestimate your income, file your taxes, they get into a reconciliation. It's like, oh, your income was actually this amount. And you have to pay a large portion of those. You can't get an advance credit, you pay a large portion of those back. And I've seen last year, I saw somebody have to pay back $40,000. Yes, it hurts. So just keep that in mind. If you are in the marketplace, just be careful. Mm-hmm. Yeah, health insurance, the whole thing in itself. So here I'm going to talk about just different type of entities. You've probably heard of some of these before, but I'll go into one each a little bit here and kind of give pros and cons and my thoughts on it, but feel free to ask questions. And the one thing I will say is starting your own business, I tell people to try to keep it simple. I don't want you to start a new business and jump into one of the most complex structures because it's so early in the business life, it may or may not make sense to even go there. There's other considerations here as far as you have multiple owners, there's liability protection, you hear LLC terminology, and what's your long-term plan of the business? Are you want to keep this forever, or you want to get into it and sell it at some point? So that might determine what kind of choice of entity you pick. So here are the ones I'll be talking about. Probably the most common. But I'll go through each one of them, and then again, if you have questions on it, just let me know. And yeah. So sole proprietorship. This is by far the easiest. This is, hey, I started a business, filed my paperwork with the state, filed with the city and borough, got my sales tax stuff. You're in business for that point for the IRS. And how it works here is you're on a Schedule C, which you may or may not have heard of, but it's part of your own tax return. So within your tax return, you have your PFD, W-2 wages, investment income. You have a Schedule C, and that shows your gross income and your expenses from the business, and obviously shows net income or your profit if you made any money. These are only for one owner, so you can't have multiple owners in these situations. But it's very, very simple and effective. The one thing with this, though, is like it says here, is unlimited liability. So be careful with that. I mean, if you're in a risky field, whatever it might be, if somebody, worst case scenario did sue you, they come after all your personal assets. So again, very, very unlikely, but is a possibility. Next is partnerships. So by default, anytime you go into business with somebody, you become a partnership. 2 people, 3 people, whatever it might be, that's how it works. Partnerships are pretty flexible. You can add new owners, you can kind of allocate income almost within reason to different people, and within, I mean, you can, so if one partner maybe didn't do any services versus one partner did all of it, you kind of allocate things differently within that. And there's also the self-employment tax, which I'll talk about a little later. But it's a tax that I mentioned, but that's also partnerships. If you're providing a service, you have self-employment taxes to pay as well. And with this is a whole separate tax return. So it's called the 1065 partnership return. So it's a whole separate tax return, but there's no taxes paid at the partnership level. It's called a pass-through. So all the income is passed through to the owners based on the ownership percentages. It's a form K1 that you would get, and you report that K1 on your personal return, and that's where any taxes are paid on your personal return with any other income you might have for you or your spouse. It all gets kind of condensed together. But partnerships, what I would recommend, if you're going into business with anybody, by default, you're a partnership, and I would at least start there before possibly looking into a corporation or something like that. So corporations, this is a terminology I've heard a lot. They call it like a crab pot. Easy to enter, hard to move around, and it's impossible to get out. It's
a good one.
It is. I'll explain why, but I can't tell you how many times I have a new client coming in and they say, I want to be an S corporation. And I was like, they just hear things online, whatever it might be, become an S corporation, do this, do that. And sometimes it makes sense. But typically I'll say, let's start out and maybe as a sole proprietorship early on, see how the business goes. And then you can always elect to be a corporation later on. So you're not set in these whatsoever. But the reason that the corporation is like a crab pot, it's very difficult to get out without tax consequences. So I'll get in, I'm jumping ahead here, but just be careful if you hear people saying the corporation route's the best way to go, probably worth talking to somebody about that before you do that.
And you're talking about an S corporation.
So there's an S corp and a C corp. What's that?
Not talking about an LLC.
I will.
Oh.
Okay. But yes, so C corps really quick, or you don't see many of these anymore. These are separate entities, pay separate taxes. The C corporations are the companies that you see in the stock market, Apple, Google, Microsoft, those are C corporations. I can't tell you the last C corporation new client that I've seen, if ever. So a lot of the C corporations that are still around that I work on have just been in existence for 30, 40, 50 years, where tax laws were a lot different at that time. So just as a C corp, completely separate. Sometimes you'll hear the term double taxation with these that comes into play. You do have a C corp, there are potential double taxation, which is a big reason why people don't do that. And then like for Alaska, there's actually state income taxes for C corporations versus individuals or other businesses. There's not. So I would not recommend the C corporation route. S corp, virtually identical to the C corp, except that it's like the partnerships. It's a pass through. So all the income, you do the S corp tax return, all the income or the loss gets passed through to the owners, and they report that on their individual tax return on the same form, the K1 form. And then, if you were going to go the corporation route, S corps would be the way to go, in my opinion. But it's always worth a discussion. There are some rules within S corps. Has to be an individual owner. Can't be a business, cannot own an S corporation. And there are other there's a lot less flexibility with a corporation compared to like a partnership. If you own 30%, you kind of have to do everything at 30%. You can't really change percentages as far as, okay, well, I did more services, I should change how much I get out of that. It does not work that way. So just be careful. And back to this too with the corporations, that's where you would pay yourself W-2 wages we talked about earlier. That's where how it works with a corporation, especially an S corp, is you pay yourself W-2 wages. And the IRS says you have to pay yourself what's called a reasonable salary, which huge gray area. What's reasonable? And what happens with S corporations, what you'll see is people pay themselves way too low in wages, maybe $10,000 in wages per year. So if they're paying very little in payroll taxes, and they from the side of this, they can take distributions that are not taxed free from the business. So they're essentially paying themselves way below what somebody in that field should pay themselves in taking these distributions out all cash free or tax free. So that's the reason why people say I'm becoming an S corp. But the reason, and what I tell people, the reasonable salary is if you had to hire somebody to do your services, what would you have to pay them? So that's what I've seen. That's where the IRS can crack down and say, no, you're paying yourself 10,000, while somebody in your same position probably should be getting 75,000. They can essentially go in and say, nope, you're paying yourself now $75,000 of wages, now charging you late penalties and interest on those payroll taxes that you never paid. So it's one of those things. S corps can be great in certain situations, but don't take advantage of it. Yep.
I've heard that it's not worth it to bump up to an S corp until you make a certain amount of profit per year.
There's no set standard, but yes, typically if your net income is getting $150,000 to $200,000 a year, that's after expenses, that's where it's worth considering doing that. Because you got to realize for the S corp, it has its own filings, separate tax return you got to pay for payroll services. So there's additional costs there. But that's just the ballpark figure to keep in the back of your mind before I would recommend probably looking into it. And back to the crab pot analogy, and the reason why it's so difficult to get out of a corporation is, let's say you're done the business, you don't want to do anything else. Any assets you have in the corporation, equipment, whatever it might be, vehicles, whatever it might be, and you're pulling those out, you have to treat them as if you sold them at the fair market value, even though you never sold them. So it can be a huge tax consequence that, you don't have the money to pay the tax, you didn't really sell them. So just keep that in mind. And I have had S corporations where we've had to just keep them open a lot longer than they should have been just because these assets are in there and we have to get them out. So just keep that in mind. It's not as easy to close them down as you would think. So LLCs, this is the most common answer I get is how are you taxed or how are you set up in this side? They say LLC. An LLC is strictly a legal designation. It doesn't mean anything for taxes. So essentially an LLC is to separate you from your business. An LLC can be a sole proprietorship, partnership. It can be kind of anything. And I will say it's never a bad thing. A little more upfront work in operating agreement, whether working with the attorney or seeing people do it online themselves, whether that would hold up in court or not, I don't know. I'm obviously not an attorney. And the one thing with this too is, I see people just at least from a tax perspective, wanting to jump into LLCs right away. And the common thing where I see is I have a rental attached to my house. I need to become an LLC, and it may or may not make sense. But at the same time, you also got to realize you have home insurance in the house and stuff would cover you for if something did happen. But and then with the LLCs too, if you do go that route, make sure you do it correctly, because a lot of times you'll set up an LLC, but you'll never rename the assets in the LLC's name, bank accounts, credit cards. You never actually fulfill the entire work that you've done all this paid money for, and you've never actually gone through and changed everything. And if you were to get sued, it could essentially fall apart potentially. So just keep that in mind. If you can go the route of LLC, I'll never say it's a bad thing because it is protection, another layer of protection, but just make sure you actually go through the routes that you do that. And I will say I've had people go online and set up an LLC, which for tax purposes, I have no problem with. But again, it's one of those things where if it came to a lawsuit and whether it would hold up or not, I can't obviously tell you if it would or not. So, yes, Spencer.
You were talking about, the problem with assets when you're closing a corporation. Is that still an issue with LLCs? If
the LLC is not a corporation, no. So if an LLC is maybe a partnership or it's a sole proprietorship, you can do whatever you want.
Okay.
As far as no tax consequences pulling those out.
Cool.
So self-employed taxes, this kind of been talking about this a little bit. But essentially self-employment taxes is a 15.3% tax on the net income. So after taxes or profit, I'm sorry, no, after expenses, I'm going to say, or the profit of the business. This can be a big shock to people because this is in addition to your federal taxes. And what I will say is a very ballpark figure, just at back of your, keep in the back of your mind, is roughly 30% of your net income from the business is going to go to taxes. That's a combination of your federal and your self-employment taxes. Again, it's just a ballpark figure, depending on what other income you have, other circumstances, it may be different, but just keep that in mind. It's a large percentage because, like I said earlier, is that you no longer have an employer paying a portion of those.
What about in places where you are selling your art or whatever through an online marketplace, like through Amazon or through Etsy, and you get a 1099? How does that impact?
So 1099 is just, it's reporting the income that you got from that, whoever it is. And a lot of times, you've already tracked that income in your spreadsheets and all that kind of stuff, so you don't have to worry about it. The one thing to keep in mind though is, a lot of times there may be fees they take out and you're maybe reporting the net amount after the fees. Just be careful. If you ever have a 1099 that's larger than the gross income you're reporting for the business, that could cause an IRS notice because they're saying they're trying to match to it. They're saying, okay, this 1099 showing you reported, $20,000 in returns only showing 18,000. So you get a nasty letter from the IRS saying you owe us tax and penalties, and then you have to explain, no, I don't. This is why I reported the net amount after fees or whatever it might be. But 1099s are common. And the one thing is just make sure that income should be included in your business income. Next, estimated payments. I already talked about these, but those are the due dates: April 15th, June 15th, September 15th, and January 15th. And the January one is of the following year. So like, for example, last month, January 15th, that was the fourth quarter payment for 2025 estimated payments. So accounting methods, cash or accrual. You may have heard these methods before. And obviously cash is the easiest to understand. Cash in the door is income, cash out the door is expense. And it's probably the most common method people start with. Accrual is more when the service is provided. So for example, I provided a service in December, but didn't get paid until January the following year. That's in that December, since you provided services in December, it's taxable income in that year. Versus cash, it wouldn't be income until you actually got paid for those services. Same thing with like expenses, accounts payable. If you provided something in December, but didn't pay them until January, the accrual method, it'd be included in the December year end. Cash method, it'd be actually included in the next year when we actually paid for that expense. There's pros and cons to each. And where it comes into play is if you have a lot of income or expenses that overlap kind of that year-end time frame. A lot of businesses don't do that or have issues to worry about, so it's not a big deal. That's where you can see where a cash versus accrual can make a big difference or not. You can always go back and change too. So you're not set. Again, this is like some other things. You're not set with this if you want to change in the future. That 1 year might require a lot more work to change, but you can change it. If the business is growing bigger and you start with the cash method, and maybe accrual might make more sense at some point in the future. So retirement. This is one of the areas I see a lot of self-employed people, especially, I don't think invest enough for retirement, just because a lot of times maybe the money's not there, but it's something that you should always consider, especially if you don't have another retirement option. Maybe, if this main self-employed business is your main business, I think you should always consider doing some sort of retirement options. First ones here are traditional or Roth IRA. And these are actually not directly related to your business, but these are good options. You have to have some sort of earned income out the year as well to be able to contribute to these. The limits are fairly low, $7,500. And if you're over 50, you can get $1,000 catch up. And then the traditional, typically, depending on where your income is, you get a deduction in your tax return that year. Versus a Roth, you do not get a deduction, but you're able to take the money out tax-free in the future. So there are different trains of thoughts here. just, this is where maybe a financial advisor would come good into play. But just my personal opinion, I think it's good to have a combination of some pre-tax retirement, like a traditional, and then some Roth as well. It doesn't hurt to have a combination of both. Another one is a SEP IRA, and this is probably by far the most popular one for self-employed people. It's very easy to administer. You actually have up until the due date of the tax return to actually make a contribution. So if you're on extension, you technically have until October 15th to contribute for the contribute to the previous year's retirement contribution. So it's nice in that respect. The one thing is, if you do have employees of the business, there's potential, if they meet the eligibility requirements, you'd have to contribute to them as well. So that can be maybe a deterrent just as far as cash wise, how much cash you have, do that. But if you're a single member, you can contribute. Yes.
I'm assuming that if you have a contractor as part of your business, that would not be under that, correct?
Correct. And just ballpark figures, it's essentially the maximum you can contribute to a SEP is about 20% of your net income from the business. So if you made $100,000 net, about 20,000 in retirement. But obviously you could do less than that if you need to. A few more options, simple IRA, kind of, it's another option, makes, in the name of it itself, simple. I don't see near as much as many of these just because a SEP is that much easier, but you can kind of see the rules here, up to $17,000. And then obviously there's limitations on how big your business can be. And there's obviously mandatory employer contributions to this. So that's where a SEP IRA, there's no mandatory contributions. It's kind of just the employer giving money. It's where it's, I see it a lot more often. I think I have maybe a couple clients with simple IRAs versus SEP. I probably have 100 plus. So that just, to show you how much it's used. It's not much anymore. Next, 401k or solo 401ks for kind of one person operation with no employees. These are popular as well. It's, for 2026, I believe that 24,500 is the maximum. Plus there's you can have an employer contribution on that as well. So if you're potentially looking to make some large contributions to retirement, a solo 401k might make sense. There's more administrative costs and stuff like that as far as, to maintain it. And there's our filings with that retirement plan. So my recommendation to kind of be the step back would be the traditional Roth IRA. And then if you do have some business income, the SEP would probably be easy. It's just so easy. I know clients who've called financial institutions, set up a SEP within one day and made the contributions. It's that easy. So these are the kind of the two or three between the traditional Roth and the SEP. These are the ones I would focus on, especially for a smaller self-employed business. Planning. I think, being self-employed, whatever field you're in, this is where it can be useful to have a tax preparer or a CPA. I can see if you're a W-2 employee, there really isn't much you can do planning wise, but self-employed, that's where you can kind of talk. And a lot of my clients, I recommend, hey, let's touch base maybe October, November before year end, and let's see if there's anything we need to do before year end to get a deduction here or buy an asset here, or maybe not. Let's wait until the next year and just talk through things, because that's where you can have a lot of opportunities to save taxes. Kind of like I just said here, like the accelerated depreciation options, timing of income and expenses. There are options there, and there may be not much we can do, or there may be a lot we can do, but it's just something that always, when you have time left in the year, and I unfortunately a lot of clients that come in January, and I'm like, sorry, we're kind of late at this point, not much we can do. So just keep it in mind. If you do work with somebody, it might be good to touch base, especially if you have maybe it's a bunch of income that year where it's unusually high and it's like, uh-oh, what do I do? But I will say too, that on the kind of opposite side of this is don't spend money just to spend money either. If it's something you need for the business, yes, but it's just, if you're buying it just to save in taxes, no reason to do that. For every dollar you're spending, you're maybe getting a 30-cent deduction in taxes. So you're not money ahead in that way. So just keep it in mind, because that's very common where I see people wanting to spend money just to save taxes, which is not good tax planning. Spencer?
We've got a question in the chat from Diane. She asks, does putting money into the SEP reduce income?
It does. Sorry if I didn't clarify that. Yep. So the Roth is the only one that has no deduction for putting it in because you get pulled out tax free, but all those other ones, the 401k, the SEP, you all get a deduction for putting that money in. And I will say, it's not the biggest tax savings in the world, but it's something. So, and just keep it in mind. That brings up a good point is, with the SEP IRA, is when you have April 15th coming up, it can be a big hit on cash because you might have taxes due from the prior year. You have your retirement contribution due, and then you have the first quarter estimated payment for the following year. So it can be a big hit on cash. A lot of times I'll meet with my clients and saying, hey, this is where things are looking. And total cash out the doors between these three options is going to be this. And that kind of helps determine if how much they're going to contribute to the retirement, if they have, how much cash they have available.
Then a follow-up question, when and how do you get it out of SEP?
I like pulling it out. I'm assuming it's just when you're of retirement age, 59 and a half, you can pull it out as needed. You eventually have RMDs, required minimum distributions, when you get old enough. But it's similar to any other retirement account you have. All right. So these are next few slides are just stuff that I think are important for self-employed or just anybody in general. The first one is community property agreements. And Alaska is very unique with this. Most states are either a community property or not a community property state. Alaska is one you can actually elect into. And where this comes into play is like if husband and wife, if they have jointly owned assets together, whether it be stock investments, rental properties, whatever it might be, is if you have a community property agreement in place, when that first spouse dies, you get what's called a basis step up. It can be confusing, but essentially that first spouse dies, you bought the rental property $100,000 20 years ago, it's now worth $500,000. That step up takes you up to the $500,000, and that's your new value determine any gain or losses off of. So it can be a huge tax saving mechanism. If you didn't have a community property agreement in place, you get what's called a 1/2 step up. So whatever my example there was $500,000 new value, you only get the $250 step up plus half the original purchase price. It can be confusing, but this is something I meet with most of my clients, and especially if they have a lot of jointly held assets. You're going to go update a will or a trust. Bring this up with your attorney. This is an attorney who would set this up. As a CPA, I don't do this. I just want to make people aware because the one example about 4 or 5 years ago, I had a lady who unfortunately her husband passed away, no community property agreement, and they had to pay about an additional $80,000 in taxes. So it's just I almost call it an insurance policy just in case, but I would if you are working, with an attorney, I would make sure to bring it up. Most Alaska attorneys are aware of this, but if you're working with somebody out of state, make sure they're aware of that. Financial advisors, there's a lot of them in this town. They may not be for everybody, but if you're unfamiliar with finances as far as investing and stuff like that, it might be good. Like me as a CPA, I cannot give you financial advice. So we can talk general terms, but I can't tell you to go invest in this stock or this in bond, whatever it might be. I can't do that. So just keep it in mind if you're ever at that place where it's like, oh, I'm kind of over my head here, it might make sense to me to speak with a financial advisor. This last one here I came across. I've actually never taken this deduction. The nickname is a starving artist deduction. And this is like performing artists. So this is like actors and stuff like that. And again, I think our office has seen this once in the last 15 or 20 years. But essentially there's a deduction allowed if your income is below $16,000, which is very, very low. And you have some W-2s from, places you were actually, do an actor or an actress for, you have a potentially for a deduction here. What I will say, the only time we saw this was with like a child actor. Their income was very low, and there's deductions they get to take. But again, 99.9% of people this wouldn't apply to. But it's just something I figured with today, I would throw it out there. But mostly it'd probably come into play if you have a child actor or actress. Some tax law changes for 2026. You've heard of the Big Beautiful Bill. And there are a few changes here. We don't need to talk political anyway on this, but this was the new bill last year. You've probably heard no tax on tips or overtime. So if you did get any tips or pay any overtime, there is a potential deduction for that. For overtime, you would need the total amount you were paying overtime throughout the year. Tips is obviously pretty straightforward. And more than likely you get up to, for tips, I think it's a $12,500 reduction. But the main thing is, if you are doing your own return TurboTax, it probably should ask you for that, but there is potentially a deduction for tips or overtime. So keep that in mind. SALT deduction, this stands for state and local taxes. Essentially, this was capped at $10,000 before. It was brought up to $40,000 this year. And essentially, that's if you take your itemized deductions, which I'll talk about here in a second. The biggest for Alaska is property taxes. So if you happen to pay a bunch of property taxes that were over $10,000 previously, you were limited. Now you get a full deduction. Electric vehicle credits, those went away September 30th. General energy credits, most of those went away from December 31st. But like the heat pump credits you may have heard of, those are all gone. Starting next year, 2026, and everybody will get a deduction for $1,000 or $2,000 if they give that much in charitable contributions or more. They'll get a deduction for that. So keep that in mind. Keep track. Whatever donate to the Jack, whatever it might be, any of those nonprofit organizations. Keep your receipts. Senior deduction is started in 25, but anybody over 65 years old gets an additional $6,000 deduction. There are some income limitations on this, but it's just out there for you.
Can I ask a question about charitable deductions?
Yeah.
I just heard this, but it seemed like for you to have any sort of deduction for charitable donations, you have to have given a minimum of like $20,000. Is that?
There's no set amount, but
okay.
Not counting this new rule I just mentioned for next year, but yes, it had to be a significant amount before you probably got any benefit.
Okay.
And I'll talk about it just here on the next page. And this is where you get the standard deduction versus itemized deduction. And the reason charitable contributions have not, probably get no benefit tax wise is because the standard deduction is just so high.
Mm-hmm.
As you can see for 2025, it was $31,500 for a married couple. So with standard deduction versus itemized, you take the higher of the two. And itemized deductions, as you can see, are medical, state tax, supposed to be state and local taxes, mortgage interest, and charitable contributions. In medical is kind of a two-part test. I will say, unless you happen to have thousands of dollars out of pocket, you're not going to get any benefits for medical. And then state taxes, that's real estate taxes and mortgage interest. So to really get above that 31,000, you probably have a pretty large mortgage. But there are also limitations on how much you can deduct there. And then charitable contributions. So that's just where, if you're giving a couple $1,000s to a charity, you're probably not getting a tax benefit to that. It's, still not a bad thing to give, but for tax perspective, you're probably getting no benefit to that.
Helps when you
What's that?
that helps when you get that. I was just
And then one thing here, which doesn't apply to most people, but once you turn 70 and a half years old, there's what are called qualified charitable distributions. Essentially, you can give charitable contributions from your IRA accounts, your retirement accounts. And this is huge. This is where essentially whoever financial institution you're working with, you say, hey, I want to give the Jack $10,000 from my IRA this year. And they'll write a check directly from your IRA to the Jack. And with that, essentially it's a direct reduction. So I had $25,000 I took from my IRA last year, $10,000 went to the Jack. I only have to pick up $15,000 of income. So it's a direct reduction of income versus itemized deductions. You probably wouldn't gotten any benefit for that. So that's just for the retirement age people, that's just a huge tax savings. If you're going to give to charities, you might as well do it from your IRA. Other than that, that's kind of all I had. Hopefully I didn't bore you too much. I kind of covered a lot there. I'm happy to take questions, answer anything I can, and wherever it might go.
Is there any tax things to be aware of for paying advertising costs for online advertising?
That's just a direct deduction. So advertising expense is what that would be. Like any other business expense, you can deduct that.
All right, I'm opening it up here for Zoom attendance. If you have any questions, you can feel free to unmute and ask, or just type them in the chat.
And I'm happy to. I know I work Elgee Rehfeld here. If you have a quick question, don't feel free to give me a call. I mean, I don't mind have a couple minute conversation with you. I'm not going to charge you for that. So if it's something you don't want to mention in front of people here, whatever it might be, feel free to call our office.
Can I share your email?
Yeah, that's fine.
Okay.
You had said the sort of limit, or like loose limit that you want to think of before considering an S or a C corp was around like $150,000 profit.
Mhm.
Is there any, does that still apply to LLCs or is LLCs just whatever?
It's the same thing. So if you have a an LLC, like sole proprietorship, kind of one of the same, that's the same thresholds. It's just, yeah, like I said, the S corp, there are just additional requirements of filing and stuff like that to be careful. And yeah, I wouldn't, for the most part, never jump directly into an S corp, directly starting off.
Were you asking if, you should have that level of income in order to make an LLC?
Oh, that's,
Yeah,
I
I think
apologize.
that's-
I'm sorry.
It's a-
No, that's different. So an LLC can be elected at any point. There's really no income levels. It's that extra layer of protection. So LLC is great. Again, if you go the route, make sure you do it right and have all your assets and everything else retitled in the LLC's name.
I have a question.
Yes.
So I'm an artist. I'm a musician. I received a grant in 2025 for a project, and I report, self-employment income for those purposes. Is a grant for taxes, is that just reported as a 1099? How is that?
So yeah, so that's just included with any other income you have from your business.
Okay.
So, and what I will say, unfortunately, I've seen sometimes people do get grants to spend the money on whatever else or help the business. And, they get the 1099 for the full amount, which is correct. It got paid that year, but they haven't used all the expenses until the following year.
Mhm.
So you may have, a fair amount of taxes on that income, because you haven't spent it all at year end. So I've just seen that before, unfortunately, with grant income.
Mhm.
Yes.
Do you have any tips for setting up like monthly draw or distribution strategies?
So, yeah, I mean, it really comes down to the business and how much you think you can comfortably take out. If you're a sole owner, it really doesn't matter because, whoops, I took too much out. I can always put more back in. But whatever works for you. I mean, if this is the main source of income, it might be good to have some sort of, similar amounts taken out in a consistent period of time to live off of. And a lot of times what will happen too is, you'll have your hypothetically $2,000 a month taken out of the business for you to your personal account. And then come tax time next spring, like, uh-oh, I owe additional $5,000. You can certainly write yourself another check for a special draw just for that. Is what I see. They'll do that, whether it's a sole proprietorship, LLC, partnership, or whatever, or even an S corp. They do it like a special distribution around tax time to cover any tax that you may have associated with that income.
We've got a question in the chat here. Is there any limit on gross income to qualify for a small business?
I guess I'd probably need further clarification if you're applying for, if there's a certain grants or whatever you might be loans, they may have certain requirements, but for the IRS, it does not matter. Nothing's treated differently on the size of your business if your gross income is higher or lower.
Okay. We got a thanks.
Any other questions?
I have one. My name's
Hello.
Hello. My name's Christy Ruby, and I have questions about, it's kind of hard to explain. I actually developed a Excel spreadsheet in order to keep track of my taxes and expenses, not by choice, but because I don't find anything out there that pertain to artists. QuickBooks or anything. Is there anybody that makes a actual program that we can enter that have goods and services, our inventory, our receipt spends for traveling, and we can divide all that out. I mean, the spreadsheet I have works great, but I'm actually knowing that there's a lot of people that do not want to pay the exorbitant prices a month for Excel. So is there any other program out there or app that you can download to keep track of that, which is not like QuickBooks? Because it's too confusing for most artists. So does anybody know of any other programs that are out there?
Currently using FreshBooks, which is similar. It's a
FreshBooks.
subscription-based and simpler made for creatives.
Cool.
Oh, FreshBooks?
Mhm. I
Oh,
can't remember what the monthly cost is, but it's not too bad.
I know, I will say QuickBooks probably has 90% of the market, but FreshBooks, there's another one called Wave Accounting, Xero, Xero Accounting. I'm not aware of any specific for like the arts field. Just, if you have to develop your own Excel, that might be great as well. But go ahead.
I haven't purchased any, but they've been advertised to me recently on social media. There's people that create their own Excel systems and then you just plug and chug and they've done all the formulas for you.
So yes.
yes, that's what I do now, because it's just so much easier. But I'm looking to promote more artists in skin sewing and all that, and I know that they're going to make some money. At least I hope they do. And I wanted to make it real easy for them to do their taxes, but they're probably not going to do Excel. So that's why I was looking for something more simple or geared towards us or easier to use for artists. There's so many artists out there that are just small scale and they still need to pay taxes though. So something simple.
Yeah. Yeah. Unfortunately, maybe, I mean, if they're not going to use Excel, I mean, or accounting software, probably some sort of handwritten system is probably the best. But yeah, I don't have a great answer, unfortunately.
Yeah, that's been the case. I tried to get Spruce Root to develop something like that and they just scratched their head. So
Okay.
So I actually might want to do something like that. I think there's a need for it for artists. There's so many artists out there that don't have that. So
I would
I
agree with
think,
that.
yeah, so I think maybe I will have to ask AI to program me an app because that's
Create your own and sell it. There you go.
yeah, that's how they do it now. So I keep hearing that, even though it's not perfect. Well, thank you very much. I'll look up the other suggestions that you guys did. So thank you.
Thank you.
We've got another question in the chat from Kathy, who is asking is the cost to travel to attend workshops deductible as a business expense?
So yeah, so it goes back to the intention of the trip. If it's to attend workshops for the business, 100% deductible, yes. But like I said, within reason, like I mentioned earlier, you can't just tack on a conference at the end of a vacation and call that all deductible. Yes, that in that situation it would be deductible.
Taking that vacation onto the workshop.
I'll let you make your own judgment. Any other chat? But yes.
When I'm pricing my items, I'm taking into account the cost of my labor, but I can't like code that in QuickBooks. Says anything, so I am taxed on that at the end of the year, right?
You are, and it's just, I mean, yeah, there's really no way to reflect that in your accounting software, but no, just I think would somehow calculate that because you're going to pay taxes on that income too. So roughly 30% is going to the IRS. So just trying to back into that number and what what you'll have and can live comfortably off of. And it can be difficult, like I mentioned earlier, what to charge.
Yeah.
Any other questions from our Zoom participants? All right. Here.
Well, thanks for having me.
Yeah.
Hopefully I provided, at least one or two useful things.
Yeah, no, thank you so much. This was super informative. And yeah, we'll be posting the recording of this session on our YouTube channel probably next week. And yeah, thank you for everyone for showing up. If you'd like to make a donation so we can continue doing workshops like this, head on over to our website, jahc.org. And then you can find all sorts of other information on the stuff we do. And thanks for everyone joining us here in person today.
Thank you.
Thanks, guys.
Thank you.
All right.
Ryan,